So Moody's just released a report saying that 241 companies are now sitting on their highest risk default list. This is a big deal. That's the largest number in nearly a year. Now, this isn't just about struggling tech startups. We're talking about consumer products, manufacturing, and private equity-backed firms. So what does this all mean? These are real businesses with real payrolls that can't make their debt payments. Let me give you a few examples. Conair, which is a beauty products company, and PowerStop. They have brake kits, big supply, and chain exposure. Now they're being downgraded because of cash flow pressures. And that's the phrase I want to zero in on. Cash flow pressure. Like you have it, I have it. Now you're starting to see it in these businesses. And not just the mom and pops, the big companies that we all recognize. These are big brands that are having these problems right now. They're all being downgraded because of cash flow pressure. The exact same thing the common person is dealing with right now. And this is all a result of inflation creeping in. So now let's get to the cause of all this. We got high interest rates, we got tariffs, which are creating inflation, and we got slower consumer spending. People are definitely pulling back right now. So what happens when a company has too much debt, rising costs, and falling income? This is exactly what just happened to the commercial real estate industry just a couple years ago. It's called defaults. And that's the point of this article. And I've seen this movie before in 2008. Back then it wasn't beauty products and brake kits. It was real estate developers, condo flippers, and mortgage companies. They all had the exact same problem. Too much leverage and no plan for when the music stopped. And let me tell you a quick story. Back in 2009, I got a call from a lender holding the keys for a 300+ unit apartment complex in Arlington, Texas. The property was halfway through renovation and they ran out of cash. Again, cash flow problem. The original partnership had planned luxury finishes, granite countertops, and all the bells and whistles, but had no tenants. Because in order to do renovations, you have to have vacant units, therefore no cash flow. So they ran out of money and then the financing market froze up. They walked away and just left it. Now that becomes the lender's problem. So I bought that property for pennies on the dollar. Why? Because the numbers made sense. Not based on what it could be, but based on what it was worth today. I went back to the basics and stripped down that deal to the fundamentals, which was cash flow, what's the cost to complete, and what's the property worth, what's the value when you're done with all of the work that needed to be done. And that deal became our highest performer within the next 3 years. That's what really happens when you see the default wave. Everyone's chasing perfection in the good years, but the real money gets made when the market start to break, which is exactly why I'm talking to you about this article today. Now, you might be thinking, Ken, I'm not in the consumer products industry. I'm not in Conair. Why should I care? And because the pattern is the same. So let me break this down. These companies over leveraged during the low rate boom, just like real estate developers. They didn't plan for volatility. They didn't plan for higher interest rates. They didn't plan for higher inflation. So their debt payments went up and the incomes did not. So when income goes down and expenses go up, you have cash flow problems. Does this sound familiar? That's exactly what's happening right now in real estate, especially with some of these new syndications. People bought on pro formas and not on reality. I've seen groups use short-term debt, floating rate loans, not have any reserves, no rate caps, and the moment the tide went out, guess what? They got caught swimming naked. If you want to see what my company looks for in a deal, you can download it for free in the link in the description here. And by the way, not all deals are great. So Ross and I, during the GFC, we were offered a 250 unit deal in Texas as well that was 50% vacant and owned by the bank. And because the bank couldn't finance it, they were going to basically hand it to us. But then we, of course, had to guarantee the loan. And they were going to also give us the money to fix it. But the cost of the loan plus the cost of the money that they were going to give us to fix it did not even equal what we thought the value would be when it was all finished and the dust had settled. So we passed. So not all deals in downturns are great either. So what you guys might already be experiencing in the real estate market is starting to creep over into the consumer products market. And it's really an important thing to watch because those are your tenants. Those are the people that pay your bills. So if you're a real estate investor right now, this isn't just a corporate default story. It's a wake-up call. So you've got to be asking yourself, is your deal cash flow positive today? Can it survive another year of tight credit and inflation? Will you have the income to survive the next 12 to 24 months? funds? What happens when your expenses spike 5 to 10%? And what if your lender doesn't renew your loan when it matures? Because I'll tell you right now, that's what we're seeing today. In 2008, we saw tons of syndicators lose plenty of deals that they overpaid for and couldn't make the cut when they started to see a little volatility in the market. So the pattern is exactly the same today as it was in 2008.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
The common thread, they believed everything was going to stay the same and that appreciation would save them. But values, as you know, are down 30-40%. Anybody that bought anything in the last 3 or 4 years is already dealing with a massive decrease in the values of whatever they bought. I've learned my lesson the hard way, just like many others. And this is by watching my friends go under and having my own chinks in the armor myself. So Ross and I have had our problems too, but luckily we've had the cash and now the wisdom to make it through some of these cycles. And that's why I always say, buy on fundamentals, not on emotion, and not just because you can raise money. So here's the good news. Default cycles always lead to opportunities. In fact, it's this kind of environment where I've made some of my very best investments ever. Back in 2010, we bought a 580 unit deal in San Antonio from a lender, which was Bank of America at the time. And it was listed through a broker. But banks aren't supposed to own real estate, and this property was a mess. It was over 50% vacant, and half of the tenants that lived there probably shouldn't have been there in the first place, and they weren't even hardly paying rent. The ownership group had defaulted because they ran out of cash and they ran the property into the ground. Why? Because they had too much debt, bad property management, and they expected the market to continue to go up just like today. Again, the one thing that kills all deals is poor cash flow. So once the market repriced the property, that's when Ross and I decided to buy. It wasn't based on a seller, it wasn't based on a lender, it was based on market fundamentals. So we bought the property, we fixed the management, we fixed the property, we raised the money we needed to repair all the things that needed to be done, and we created massive value for our investors. It took over 2 years to do it, but once we stabilized, the property was worth almost double of what we paid. And after that, it's just rinse and repeat. We refinanced and returned that equity back to the investors, and at that point, we had an infinite return. So we fixed the property and we had no investment at the end of that period of time. And we still own that property today. Why would you sell a property that you have no investment and you get massive cash flow from? And that is the whole point. Use the tax laws at this point to reduce your taxable income. Another example is I bought a failed condo conversion. So this happens all the time. So people buy apartments and then they try to turn them into condominiums by selling them unit by unit. And the math looks good, but it's not that easy. So we find these deals all the time where somebody had gotten maybe halfway through a project and then the whole thing stalled and they couldn't sell anymore. So half is apartments and half is ownership. Usually these are typically huge messes, but I've been through it before and we've cleaned a number of these up, and we can make them extremely profitable by fixing these failed condo conversions. I'm starting to see those in the market today because when people can't make sense of the value of an apartment building that they bought, they immediately think, okay, I could sell these off individually, and typically a condo is worth more than an apartment. Not in all cases, but very commonly. So what do I look for in markets like this? Properties with distress, not markets with distress. Deals that cash flow on today's numbers with today's interest rates. Motivated sellers, banks, private equity firms, and overextended syndicators. And I ask the same question each and every time. Can I solve a problem that someone else could not? Because that's where the upside lives. So what do you do with all this? Here's the mindset. Number one, get liquid. Cash is king in distress cycles. Ross and I are stacking dry powder right now. 2, underwrite tightly. If your deal doesn't cash flow from day one, do not do it. 3, target distress. Don't be afraid of ugly deals in great locations. That's where the value often can be. Just make sure that the market still has strong fundamentals. 4, control your debt. This is what's killing everybody right now. They're over leveraged. Fixed rate, long term, no exceptions. And if you're looking at somebody else's deal, ask these 3 questions. What happens if rents drop 5 to 10% and you have lots of concessions? 2, are they relying on a refinance to survive? 3, what's the real cash flow, not the projected one? Do not rely on the broker numbers. So this corporate default wave is just beginning. But if you're ready, focused, and of course disciplined, this could be your moment. Most people get scared during volatility. I get interested. So if you want to see one of the deals that we just bought for 50 cents on the dollar, click on the link below.